On February 28, 2026, military escalation reached the airspace of major UAE cities, testing the region's status as a global safe haven. When conflict reaches a core economic zone, historical patterns suggest an immediate flight of capital, followed by a severe price correction. The sheer scale of the built environment in Dubai meant billions in asset value were suddenly exposed to this shift in risk perception. This timeline tracks the immediate market reaction. In March 2026, real estate transaction volumes fell sharply as buyers and sellers stepped back. Yet prime property prices remained stable, with valuations holding steady throughout the peak of the disruption. In most global markets, a sudden drop in activity forces leveraged owners to sell, creating a downward price spiral. That mechanism failed to trigger here. This resilience suggests the market has structurally separated from traditional debt cycles, creating a buffer between geopolitical shocks and asset valuations. To understand why the crash never came, we must look past transaction totals and into the specific composition of the capital holding these assets. The drop in activity during March 2026 is best defined as a liquidity freeze. Buyers delayed decisions while they monitored the security environment. This is a distinction between liquidity, the speed of transactions, and solvency, the ability for an owner to hold an asset without financial distress. This block represents the capital structure of an average UAE property transaction during this period. In 2026, more than 80% of property transactions were cash-based, leaving only a small fraction of the market dependent on bank financing. High equity ownership provides a significant defense against market volatility, as owners are not burdened by rising debt servicing costs. Without the pressure to meet mortgage payments, investors can hold their positions indefinitely, preventing the forced selling that typically drives a market collapse. The investor profile in the region has shifted toward long-term capital allocators who prioritize asset preservation and rental yields over short-term speculative gains. This mature capital base is visible across the major emirates, where controlled supply dynamics in cities like Abu Dhabi attract institutional wealth. The price stability observed in March was the logical outcome of a solvent, low-leverage ecosystem that had no financial reason to panic. While headline prices appeared stable, that stability did not apply to every segment of the market equally. The market began to fragment, with capital becoming highly selective based on the specific fundamentals of each asset class. Comparing the villa and apartment segments reveals two entirely different risk profiles. In the villa segment, transaction volumes dropped because high net worth buyers chose to delay discretionary purchases until the geopolitical situation stabilized. The apartment segment faced an internal challenge, a massive pipeline of over 120,000 new units scheduled for delivery throughout 2026. This heavy concentration of new supply creates a sustained downward pressure on apartment pricing that will last well beyond the initial geopolitical shock. This particular risk is a product of developer ambition rather than the external security environment. Off-plan sales maintained a level of insulation, as developers used flexible payment structures to attract buyers looking to manage their liquidity more cautiously. For investors, aggregate market trends are becoming less relevant than the specific supply and demand math of an individual submarket. While existing buildings and their owners remained stable, the true crisis began to manifest further upstream in the construction pipeline. The military escalation in early March led to a direct disruption of commercial traffic through the Strait of Hormuz. As maritime transit through this choke point slowed, the regional supply chain for construction materials effectively paralyzed. This caused an immediate restriction in the flow of critical materials, including steel, cement, and aluminum. Input costs for these materials spiked at double-digit annualized rates in a matter of weeks. These costs were further inflated by conflict-related shipping surcharges and a rapid increase in energy prices. For developers, this sudden, unexpected hyperinflation made the cost assumptions used to price their ongoing projects completely obsolete. As build costs rose and off-plan prices remained capped by market sentiment, developer margins were squeezed from both sides. This financial pressure forced many developers to delay projects and invoke force majeure clauses to pause their delivery obligations. While the market surface appeared calm, the developer sector became the true crucible of the crisis, absorbing the full weight of the supply chain disruption. The events of 2026 established a new baseline for how geopolitical risk is calculated within the GCC real estate market. To maintain stability, the Central Bank of the UAE acted quickly to inject liquidity into the banking system, preventing a broader tightening of credit. This institutional support ensured that the short-term shock to transaction volumes did not escalate into a systemic banking failure. This resilience has accelerated a shift in market behavior, where investment decisions are now driven by rigorous, performance-based analysis. Any assessment of the market now requires navigating these three distinct forces: high equity ownership, looming supply, and material cost volatility. Investors are focusing on asset-level fundamentals, such as rental yield stability and localized supply dynamics, rather than broad market momentum. For developers, the focus has shifted towards strict cost control and aligning new supply with actual market absorption rates. Mere proximity to infrastructure is no longer a guarantee of value. Every individual asset is now under closer scrutiny for its specific income-generating potential. This environment acts as a filtration system, where only the most structurally sound projects and well-capitalized investors can successfully navigate the volatility. The GCC market demonstrated that its low-leverage structure can withstand a major liquidity shock, but the ensuing filtering phase will punish those who ignore the new math of supply and construction costs.